Welcome to This Explainer. Today, we're tearing into a true heavyweight in the auto component space, the Dhoot Transmission IPO. We're not just going to skim the surface with basic dates and numbers here. Our main focus today? Deconstructing the exact five-part growth engine fueling this company, and understanding why these five strategies combined are perfectly designed to capture a massive slice of the automotive future. Here's our roadmap for today. We'll start with the IPO basics. Dig into those five growth strategies, look at financials and peer valuation, weigh the short versus long-term outlook, and finally, tackle the key risks. All right, Section 1, Dhoot Transmission IPO Basics, the hook and the details. So the sheer scale of this offering is wild. We're talking over 3,000 crore rupees. That includes a 1,400 crore fresh issue, which is literal new cash flowing straight into the company's war chest, along with a significant offer for sale of about 1,666 crores from existing shareholders.
Now, who actually gets a piece of this pie? It's looking pretty healthy for retail investors, with 35% carved out just for us. If you're looking at that bucket, you need a minimum of 14,807 rupees to lock down a single 17-share lot. The big institutional buyers are grabbing the lion's share at 50%, and high-net-worth individuals round out that final 15%.
Definitely mark your calendars for this one. The anchor bidding, where the really big institutional money steps in, hits on August 7th. The main public window pops open right after, from the 10th to the 12th. And if everything stays on track, shares should officially hit the market on August 17th.
Moving on to Section 2. 5 strategies driving growth, the engine.
Okay, here's the master plan. These 5 steps form the strategic engine for Dhoot. And what's brilliant is how they all lock together like a giant puzzle. We're talking about dominating a growing market, expanding to meet the demand, freeing up cash by killing debt, and then using that cash to scale globally. They aren't just raising money here, they're fueling a very specific growth loop. Let's break down strategy number 1.
Strategy 1 is all about dominating the EV transition. Get this, they already command a staggering 70% market share in the Indian electric 2- and 3-wheeler wiring harness market. Just think about that for a second. Nearly 3 out of every 4 electric scooters or 3-wheelers zipping past you on the road, they rely on Dhoot's components. It is a massive structural tailwind.
Strategy 2 is all about physical scale. They're taking 150 crores directly from the fresh issue to build out new manufacturing facilities in Jajur and Hosur. And why there? Well, it's all about proximity. Setting up shop right in the backyard of major auto manufacturers means slashing logistics costs and totally tightening up their supply chain integrations. Then there's strategy 3, which honestly might be the biggest short-term catalyst for their bottom line. They're dedicating over 766 crores to just wipe out existing debt. By deeply deleveraging the balance sheet, they structurally expand their profit margins. It's simple, really. Less money bleeding out to interest payments means more of that capital drops straight down as pure profit.
Strategy 4 reminds us that Dhoot is absolutely not just a domestic player. They operate over 20 facilities globally, even in places like the UK. This move is all about flexing that footprint to cement their status as a Tier 1 global auto component supplier. It's essentially a competitive moat that diversifies where their money comes from.
And finally, strategy 5. Because they use strategy 3 to aggressively pay down debt, they're left with this incredibly powerful debt-free war chest. This gives them the flexibility to opportunistically swoop in and buy up competitors or acquire complementary EV tech without having to take on new, expensive debt to do it.
All right, Section 3, Financials and Peer Valuation, the validation.
So, do the numbers actually back up the story? They absolutely reflect strong execution. They're projected to scale to an FY26 revenue of 4,525 crore rupees, with profit after tax hitting 397 crores. The stat that really jumps out to me here is that 19.14% return on capital employed. Basically, for every 100 rupees they plug into the business, they're pulling out over 19 rupees in profit. Oh, and thanks to that debt repayment we just talked about, their post-IPO debt-to-equity ratio plummets to a very comfortable 0.35x. But how does this stack up against the competition? Looking at the peers, Dhoot is priced at a 44.33 price-to-earnings multiple. That puts their valuation squarely in line with industry giants like Motherson Sumi, which is sitting at 43.24, and reasonably below Uno Minda at nearly 57. They are clearly pricing this issue to be highly competitive right out of the gate. Moving to Section 4, Short versus Long-Term Outlook, the Reality Check.
There's a really fascinating split here, depending on your time horizon. The short-term trading view is absolutely loving the immediate margin boost coming from that debt repayment, plus that fair peer pricing we just looked at. But if you're taking a long-term investment view, you're probably hyper-focused on that massive structural tailwind, that 70% market share in the EV transition, and how those new facilities in Haryana and Tamil Nadu are positioned to capture future demand.
Now, just to remain entirely objective here, current market sentiment is showing some very strong demand. The unofficial gray market premium right now is hinting at an estimated 29.28% listing gain. That would translate to over 4,300 rupees of profit per lot. Obviously, remember, this is a purely unofficial indicator based on pre-listing demand, so absolutely no guarantees whatsoever. But it definitely signals the market is eating up these growth strategies right now.
Which brings us to Section 5. Key risks to consider. Balancing the equation.
Every explainer needs a reality check, right? The most glaring risk facing this company is, without a doubt, customer concentration. Bajaj Auto alone makes up roughly 32% of their entire revenue, and their top 10 clients account for about 81%. On top of that, they're operating without binding long-term volume contracts in a space that is notorious for raw material volatility, especially things like copper and polymers. If copper prices spike tomorrow, or if a major client like Bajaj just decides to slow production, Dhoot's margins are going to feel that pressure immediately.
So, this brings us to the ultimate question you have to weigh as we wrap up this explainer. Do those 5 powerful growth strategies, especially that 70% dominance in the domestic EV transition and the massive debt wipeout, do they justify the heavy concentration risks in their client portfolio? It's a fascinating balancing act between aggressive, structured growth and relying heavily on a few key partners. Thanks so much for joining me to unpack the Dhoot Transmission IPO, and I'll catch you in the next explainer.